Hello everyone. Today we will discuss another topic under banking and insurance law. Today's topic is principles of lending. Here we will discuss about the principles which are to be followed by a bank or banking institution while giving the advances or loans to the customers or the people. The list of topics to be covered here is we will discuss the concept of lending, then certain principles of lending which are safety principle, security principle, purpose principle, liquidity, diversification of loans, and profitability principle. Concept of lending. Here, lending means to provide money temporarily on condition that the amount borrowed be returned, usually with an interest fee. A lender is a person who makes these funds available to another with the expectation that the funds will be repaid with some interest. In India, basically, the business of lending is to be carried on by the banking sector, and mostly people approach for the funds which are temporarily available on this condition that the amount borrowed be returned to them are done by the banking sector and different commercial banks only. The main business of banking consists of receiving deposits and lending for production purposes. A deployment of funds is regulated by the directives of the Reserve Bank of India. After meeting statutory liquidity ratio and investments, the funds available for lending is determined. These lendable funds determine criteria for a proper deposit ratio and for pursuing the necessary lending policies and scheme. So basically, all the policies and schemes which respect to the loan and advances purposes are formulated and regulated by the Reserve Bank of India. After meeting certain ratios, these funds made available to the other people. Lending should be in such a manner that the bank is in a position to meet unexpected demands. Lending money is the most important function of banks in the context of economic development in general and the development of the development of trade, commerce and industry in particular. Lending is not without risk. The banker has to take utmost precautions in lending because he deals essentially with the funds of other people. Those funds have to be repaid on demand by the banker. So there are certain principles or considerations for sound lending of money. We all know that the banking business is mostly depend upon the deposits by their customers into the banks, and then the banker use these funds deposited in the bank by the customers. They use this particular deposit for the advances and loans purposes to make the profit out of it. While doing this lending business, the banker has to taken care of certain principles of lending. So these are the basic principles of lending in banking industries, which are safety, security, purpose, liquidity, diversification of loans, and profitability. First principle is safety. Since a banker deals with the money belonging to others, he has to assure the safety of the funds that he lends out. If money is lent to people who do not possess adequate capacity to repay money borrowed from a bank, the banker would be in a difficult position because he will not be in a position to honor the claims of his depositors. Depositors keep money with the bank in good faith and trust. If a banker is unable to honor their claims of withdrawals, the whole banking business would be in trouble. Therefore, he must see that the funds are safe. The money lent should come back in the normal course. A few loans turn bad due to the dishonesty of the borrower, which could not be detected before the loans were disbursed. So, for safety purposes, sometimes some valuable property, both movable and immovable, which is owned by the borrower, is used as the security, and the banker takes these properties, movable and immovable, as a security and keep it with them. And after ensuring that the value of the security, the banker provides the loan to the borrower depending upon the valuable they have submitted to the bank as a security. Next principle is of security. Banks usually support their loans by asking the borrower to deposit approved security as an insurance against unforeseen contingencies. Tangible security does offer a cushion for safety, but only up to a point. In a falling market, the value of security depreciates very fast and may prove inadequate to recover the advance. Security offered by a person borrowing money is also important as it is an insurance against non-repayment. In case of default, recovery becomes easier if proper securities are obtained while granting the advances. A banker has to ensure the value of the securities while granting the loan, as in case of default, it will help the banker to recover their advances only if the value of the securities are in accordance with the granting advances. Security is taken as a form of insurance so that it is available to fall back upon in the event of some unforeseen development taking place as would jeopardize the advance. Next principle is of purpose. It is the responsibility of a banker to investigate into the purpose for which money is being borrowed by a person. Repayment of loans depends to a large extent on the purpose for which the loans are being taken. When advances are guaranteed for productive purposes, resulting in the creation of income yielding assets, and there is a guarantee of repayment also. In case of default, such loans are recovered by sale of assets, but if loans are given for unproductive purposes, there is a lot of uncertainty about recovering such loans. The banker has to examine whether the purpose for which loan would be used is desirable one from the point of view of the accepted economic policies of the government and the directives of the country's central bank. Next principle is liquidity. Liquidity means a bank's ability to meet any claim on it for cash on demand. It is the capacity of the bank to honor its obligations. It implies the readiness with which the bank can convert its assets into cash in time of emergency. Since a banker does his business with the borrowed money which is subject to repayment on demand, he has to ensure liquidity while lending money. Depositors develop faith in bank on the basis of liquidity. Therefore, this principle is as important as that of safety. Another reason for the importance of liquidity is that the cost of borrowing from the RBI depends on net liquidity ratio, that is, the ratio between net liquidity assets and the total demand and time deposits. Next principle is diversification of loans. Since every loan has a risk, it is better to give advances for different purposes and spread the risk. It is dangerous to concentrate advances in any particular area or field or sector. It is always good to have a wider spread in terms of the number of borrowers, number of sectors, geographical area, and securities. The basic idea behind this principle of lending is not to keep all eggs in one basket. Banks take calculated risk in granting loans, but sometimes their calculations do go wrong. To minimize the incidence of losses as a result of advances turning bad, a bank spreads the risk by dispersal of its funds to a large number of borrowers instead to confining of its advances to a few by releasing large amount to them. Next principle is 6 profitability principle. A commercial bank is essentially a profit hunting organization with the main objectives of making profits. The banker is in a position to earn profits through advances. Profits of a bank depend upon the interest income earned on the advances made. Therefore, bankers should not ignore the profit motive while granting loans. A bank should ensure that the funds that are lent bring a reasonable good return. At the same time, they should also possess liquidity. In other words, a bank has to reconcile the objectives of liquidity and profitability and maintain them in optimum proportion. A profitability of advance is to ensure adequate income to cover up the bank's cost, that is interest rate, establishment charges, their non-interest charges like office maintenance, depreciation and bad debts.